Hey everybody, it's Kevin once again coming to you with Weeds Weekly Wrap. We talk about this past week. We talk about the upcoming week. I have some random thoughts for you. And then I'm going to dive into change is good. So what do we have to discuss? We're going to talk about kicking the can, still sticky, contagious. It's bunny time. We're going to talk about proceeding with caution and adding fuel to the fire. So let's dive in. Let's talk about last week. And I kind of brought you up to speed on Friday, but just real quickly to rehearse, the most important thing that came out last week was the Fed. The Fed announcement, as many already had anticipated, they did no changes to the Fed funds rate. I think they did very little in actually changing their language. And in my opinion, they simply just kicked the can down the street, much like politicians do. They didn't really say much other than, hey, we're trying to look for inflation to get a read as it was back in late 2023. Inflation has been really sticky so far this year. However, we still anticipate that we have 3 Fed rate cuts in us in fiscal 2024. And we're going to dive into it a little bit later when I talk about proceed with caution. But I think that, it'll be better explained why I believe kicking the can. No. Hey everybody, it's Kevin once again coming to you with Weeds Weekly Wrap. Every week we discuss the past week, the upcoming week. We talk about some random thoughts that yours truly has, and then I cover a topic which this week, change is good. So what are we going to talk about? We're going to talk about the Fed kicking the can. We're going to talk about still sticky inflation. Contagious. We're going to talk about it's bunny time. We got Easter coming up this Sunday. We're going to talk about how traders are proceeding with caution and how the government is adding fuel to the fire. So let's just dive right in. Came to you on Friday and basically gave you an update, which I'm going to continue to do every Friday. I think it's imperative as we head into the weekends, especially during these critical times. We get a great pulse on, hey, where is the market at with regards to interest rates and what can you be prepped with heading into the weekend? But going through last week, the biggest news last week was the Fed. The Fed had their announcement, their second policy meeting for fiscal 2024. And essentially, in my opinion, all they did was kick the can. Inflation remains to be sticky. We know that. They still believe that they have 3 Fed rate cuts for fiscal 2024. And really what that did is it just laid out that optimism that the Fed was still optimistic that they are on track to get to their 2% number. Inflation, while it remains to be sticky, they believe that it's going to correct itself and we're going to start seeing the trickle-down inflation that we saw at the end of 2023. Although since we've been in 2024, it's been on the increase. However, they were very optimistic with their verbiage. They could have really sunk the ship that was sinking, as we talked about last week. But really what they did is they provided good optimism. The markets loved it. We saw the stock market rally. And by the close of business on Friday, Treasury traders liked it also. We got below the 7% number as far as the average 30-year fixed interest rate as we head into the weekend. So that was good stuff, right? But let's really think about what I meant by kicking the can down the road. The Fed is essentially, in my opinion, kicking the can down the road because they have upcoming policy meetings, May 1st, June 12th, July 31st, and September 18th. That is 4 policy meetings over the span of 5 months. They right now have the ability to kick that can down the road, indicating, hey, we still believe that we have these 3 cuts coming because we're hoping, fingers crossed, that inflation's going to come down. It's going to stop being so sticky, that our policy, our increases are actually now funneling their way through the economy, and we're going to be right in our projections. Optimism and their ability with those upcoming meetings in succession is really why I believe they just kind of kicked the can down the road and said, nah, let's just see what happens. We still think we're on track. All right. So that's what I meant about still sticky. And as far as contagious, that contagious optimism flowed over and got us below the 7%. So that was a good thing. The next thing we got to talk about, it's bunny time. We have Easter coming up this weekend. And while we have some very critical I think. It's not as high level as your CPI number or your jobs numbers used to be, although the Fed kind of squashed that a little bit. But we do have some big data points coming out this week. And the biggest ones, in my opinion, are the following. We have core PCE, you have the Fed speaking, and you have consumer confidence. Now, the thing to know about this week and why I called it it's bunny time is because the market is going to be closing early. We have a very condensed short week. It's a half a day on Thursday and we are closed on Good Friday, which really means that I believe, and that's why I wrote proceed with caution, is traders are going to proceed with caution. My anticipation is early this week, we are going to see rates actually creep up ever so slightly. They are going to absorb the data points that are earlier in the week. Consumer confidence comes out on Wednesday. I do not think that's a big market mover, but the reason that I indicated it's coming out is because to me, it's going to get a clear indication of where we are headed in the future as far as the economy is rolling along. If consumer confidence continues to slip and really drag, it is going to be a clear indication that spending is going to halt. You're going to see the price of goods and services eventually come down. Now, is that in 3 months, 6 months, 9 months? Don't really know that yet, but the fact that the consumer is continuing to pull back and say, whoa, 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 brakes, we're beginning to have a hard time. And we're seeing that in other numbers, but I think that's a critical number for future indications. But the bigger numbers, okay, as far as, your initial jobless claims, as I indicated, your core PCE, and also what was the other one I mentioned really quick off the top of my head? Oh, Fed Powell speaks again. That's happening on Friday. The market's closed, which means that traders who want to go hang out with their family, eat candy, go on Easter egg hunts, and eat a ton of ham and whatever else, they are going to posture themselves and not expose themselves to a market that is not going to like those data sets on Thursday and Friday, and then come back on Monday and just be crushed. So I highly anticipate that you're going to see, if anything, rates on the slight increase this week to possibly getting above a 4.4% ceiling on the 10-year Treasury with some data that comes in against us and is inflationary. The other point, as far as a thought, is, our government, much like, a household that can't stop spending and just continues regardless of the fact that they need to save money, regardless of the fact that they continue to put themselves into debt. That's what our government is currently doing. They are adding fuel to an already inflationary fire, which in my opinion is a real problem. It's putting the Fed behind the 8 ball. The government continues to pump money into the economy by just kicking the can, heard that before, down the road with regards to extending these averting government shutdowns now till September. And all it is, it's just pumping more tax dollars, printing more money and pushing it into an economy that's already trying to fight inflation. In my opinion, what the economy really needs is a hard landing. It needs the government to stop spending, to pull back. We need a recession if the Fed believes it's going to get to the 2% mark of inflation. And what I think is going to happen is the Fed also being political, because I think every division of government in some regard is political, is going to move those goalposts. They're going to justify that 2% was the goal. We see it correcting. We're now at 2.8, 2.5. We believe that we get there. We don't want to stall the economy, so we're going to begin to reduce the Fed funds rate a little bit earlier than usual, regardless of being at the 2%. So that's why I believe that they basically provided that optimism, that they still believe the 3 Fed rate cuts are coming, because they also know that the elections are coming. And they're going to need to do something because, again, i.e. moving in a political environment and wanting to create the soft landing that they've been preaching forever and not the hard landing, they're going to move the goalpost of where they really want to be. And therefore, we are going to have those rate cuts a little bit sooner. But again, it's just adding fuel to the fire. The government just cannot stop spending money. So it's something to be really concerned about. And now we don't have to worry about it until September, right before the election. And obviously, that's going to create a lot of tense moments, especially as we head into that election. And lastly, look, there's been a lot of discussion around NAR, the National Association of Realtors, and the settlement that just came down and all the changes that are going to happen to the real estate industry. And I'm here to tell you, first and foremost, based on over 20 years of experience in the real estate space, both in real estate, mortgages, building, flipping, all of the above, real estate is a roller coaster. It has forever been since I've been in it, and I don't think that is ever going to change. But the biggest part I want to say is I see all this negative press and all these fear that is being created with the unknown. But at the end of the day, change is good. Change is wonderful for you as an individual. It provides growth in you personally, growth in your business, gives you an opportunity to reinvent yourself, gives you an opportunity to recreate processes. It gives our buyers, our clients, an opportunity to feel that they are now more intricate in the part of the process. They feel like they are getting more bang for their buck. And it also provides you the opportunity to become the outstanding agent that you are by describing your value and then executing your value of what that's worth. Getting that contract in place, negotiating with your client up front. This is all I'm going to do for you. This is exactly how it's going to be done. It's going to create a better real estate atmosphere in the end. So as always, don't fear change, embrace change. Change is good. And I'm going to dive in a little bit more into that NAR settlement because I have my own thoughts on who it's going to affect, who it helps, who it hurts, and so on and so forth. And I'll bring that to you at a different time, probably later this week. I'll dive into that discussion. But as always, hey, have a fantastic week. Have a happy Easter. If I don't talk to you, I will come to you on Friday once again and wish you a happy Easter once again. But if you check out, have a wonderful one. Enjoy your friends, your family, or whatever you're doing. Get sick on candy. You need anything, give me a call. And remember, I definitely anticipate that rates go slightly higher to potentially above that 4.4% ceiling that we're currently at, data dependent. But traders are definitely going to hedge given that we have a half day on Thursday and Good Friday, the markets close. All right, y'all. Happy selling this week. Have a great one. Talk to you soon. Cheers.